Friends, good morning. Welcome to our Saturday webinar organized by Knowledge Sharing Series by Mehta and Mehta. Today's webinar topic is Masterclass on Companies Act 2013, an insight into the issue of sweat equity and employee stock options, normally referred as ESOP. And today's our panelists are Ms. Satya. Welcome, Ms. Satya, to our webinar series. Ms. Satyasri is at the forefront of Rule Zero's mission to transforming private markets by bringing liquidity to previously illiquid assets. As the head of the legal team, Satya spearheads Rule Zero's innovative approach, overseeing the development of their proprietary platform, HISA, which empowers founders, employers, and investors to seamlessly manage. With over 2 decades of experience spanning venture capital, private equity, and corporate advisory, Ms. Satya brings wealth of experience and expertise to her role. Prior to joining Rule Zero, she served as a partner of InvestLaw, a prominent law firm in India, where she played a pivotal role in advising entrepreneurs, businesses, and investment funds through various stages of financing, merger amalgamation, and exits. Ms. Satya's passion for supporting startups is evident in her track record of guiding numerous companies from inception to successful exit, including some of the today's unicorns. Beyond her professional endeavors, Ms. Satya remains deeply committed to nurturing the next generation of entrepreneurs, frequently offering mentorship and guidance to startups in their early stage of development. Welcome, Ms. Satya. Thanks a lot for your time. Our participants will look at you for your experience and expertise. Surely we'll gain it.
Thank you.
Thank you. Our other panelist, Mr. Bala, is a company secretary with almost 4 decades of experience, regular speaker and writer of articles. And Mr. Sudhakar Saratula is one of the prominent personality associated as a chief consultant with Mehta and Mehta. Is a member of Institute of Chartered Accountant, Institute of Company Secretary of India, and Institute of Chartered Secretary and Administrator UK. He worked as the Vice President of Corporate Secretarial Department for Reliance Industries Limited for 17 years. Friends, our today's presenter is Ms. Jaswin, and Ms. Jaswin is our partner of Mehta and Mehta, and present today's webinar. Thanks a lot for joining here. Now I'll request Ms. Satya to say a few words on the ESOP, then Mr. Sudhakar, and then Mr. Bala, and then Jaswin can start the presentation. Friends, as usual, please put your queries on the chat box, and at the end of the session, we'll allow, if you raise the hands, to everyone to speak. Thanks a lot. Over to Ms. Satya, please.
Thanks, Ms. Deepti Mehta for the warm introduction, and thanks to Mehta and Mehta Law Firm for giving me this opportunity. Good morning to everyone, and really excited to be part of this knowledge sharing session today. Just by way of quick intro, I know Deepti has done a warm introduction to us, but I am currently VP Legal at Rule Zero. What we are trying to at Rule Zero, our platform helps companies manage capital transactions. It could be shares, equity preference, debentures, warrants. Essentially, we are trying to automate processes and help issuance of these different securities. And you all know that even options are a security. So one of the key products of our company is an ESOP management platform, where all processes have been automated, and that's where having worked on that is where our expertise comes from. Today, we have about 150 plus customers using our ESOP platform to manage their ESOPs. This includes companies like Cred, Big Basket, 1MG, Moneyview, Netcore, etc. So for today's topic, which is sweat equity and ESOPs, I would take just a few minutes, just to coming from company's perspective, even before a process of we get into how we can issue it, just wanted to concept why do companies want to issue, right? And why are people who are receiving these would like to receive it. Now, if you look at let me start with the employee side, right? And it's always important either from an employee or director. In case of sweat equity, what is it, right? Now, if you traditionally look at it, the compensation, is what people get for services they render. Now, compensation has evolved over a period of time. It includes some rewards. It includes some benefits, employee benefits, etc. But what has happened, and especially during the 75 years of India journey post independence, is especially post 1990, is people are getting wealthier. Okay, and what I mean by this is, right, and the best way to explain this is, um, when we get compensated for salary for services, we typically use that money for three things: roti, kapda, makan. And that's the start point, right? We all start with roti, kapda, makan. When that is met, our next thing that we use our money is to upgrade our lifestyles, which means I'm moving from a Maruti car to an Mercedes car, or I'm moving from a Vivo phone to a HTC phone, or a OnePlus, or even to a iPhone. So the more money you have, what we typically do as people is we are trying to improve a lifestyle. But along with that, something very important happens is that we also go and save money. And the money that we save, we go and invest. The reason for that is that we want to save for a rainy day. And I want to just bring in one important point: the difference between saving and investing, right? You save because you want money for a rainy day, and we all save for that. Whatever money is saved, we go and invest. What I mean by invest is you're actually putting this money at a place where the money also grows by itself without we doing anything from that perspective. And that's investment. Okay, now why is it important? And I'll come back to the topic of ESOPs and how it is relevant. Is typically what are the places we invest in? We start with FDs, um, most risk free, and we all love them, and we have all known them. And traditionally, I don't know the average age of this group, but I'm assuming if you speak to people who were earning in 70s and 80s, they would have put all of their money in banks in the form of FDs, and the reason is they are risk free. But the problem with that being risk free is they give you an average return. They used to give an average return of now 9, and it is down to 5 to 7%. The second part is after FDs. Okay, you have enough FDs. The next part is we invest in gold. Gold is pretty interesting, right? Gold has probably given the best returns over a longer period of time that you take, right? But there is a problem with gold. You can't buy too much gold, and because you have to now physically save it, and also the day liquidity is tough. That is, you can't carry it and get money whenever you want from that perspective. Then came the listed securities. That is, all of us went go and invest in stock markets, right? And that's the new age instrument that everybody has been trying to do to invest and generate wealth for themselves. And if you look at these three, the return is 7% in FDs, probably 12% in gold over a 6-year period. And if you go to the listed securities, and if you have picked up the right kind of securities, your return is anywhere from 18 to 20%, or 22 in a best case scenario. But in modern day, people have figured out a way where you can even beat this 22%. And that instrument truly is employee stock options. Okay. And the reason for that is when you join a company at the start of its growth, which is early days of a company, when it is still growing, it actually grows. And if you would see, keep reading the newspapers, it's actually growing 3x, 4x every year in the first 6 years. And which means that if you take options of this company, your money is also growing at that rate. Even if later years the growth actually plateaus, on an average, the employee stock options have grown at not less than, in a good company, the employee stock options have grown at 155%. And there's nothing to beat that percent, right? So what the modern day people are saying, employees are saying is, even if I make more money, I have to go and invest, and I have to spend time and energy to invest. Instead, if I am investing this money in the form of options in a company that I know is doing well, then my return can beat what I can make using my time and energy trying to figure out what happens in a listed company. Right. And that's purely coming from an employee perspective. What I'm trying to do is, I am trying to see if in a single generation I can generate wealth which is beyond our own generations. And today, the one instrument for people who are employees that can create that is ESOPs. Which is why if you see the madness that is happening in the market today, especially in startups, where if you take Flipkart, if you take Big Basket, if you take any company that has given exit, Zomato, Policy Bazaar, Paytm, Nykaa, the first 100 employees have probably made few crores in the last few years just by being an employee, which was not heard of
Miss
earlier.
Satya,
Yeah.
Miss Satya, just I'll interrupt, sorry, but our audience is very well aware with the ESOP because all are qualified CS, no? And actually,
Sure.
rather they themselves has also backed the ESOPs. That level they are. So we can make it compliance oriented more and operative oriented more. That will
Sure.
be fine. Thank
Sure.
you.
Thanks. That was helpful. That was the question. Okay. So that is why ESOPs have become popular. I'll just take a minute to close it. More and more companies want to give ESOPs, and Jasween will be walking through the compliance aspects of this. Sweat equity, though, is a very different problem, and you will see Jasween walking through sweat. But that's the reason ESOPs are becoming very, very popular. And on the company side, companies want to conserve capital and therefore want to give ESOPs. That's the single most reason companies want. And the second most reason is they want to share wealth with all the employees increasingly. And that is why both from employees and employers, they want to actually start using ESOPs as a form of generating wealth. That's the quick intro from my side. Thanks everybody, and over to Jasween.
Sudhakar and Mr. Bala, just 2 minutes because we are already late today.
Yes,
Thanks.
yes, yes. I'm aware of that. That thing. Good morning, everyone. Namaste, and welcome to our webinar on sweat equity and ESOPs. And in fact, every company secretary have one kind of an issue, especially the budding company secretaries. What is a sweat equity and what is ESOP? Which is to be issued and when? That is one major question. In fact, the corporates, always there is a one issue, ticklish issue, that how to attract the employees, and once after attracting the employees, how to retain them. Sometimes it may so happen attracting an employee to work for you is not that difficult, but to retain that person after a couple of years is a question mark. So you can't go on increasing his salary levels also in perpetuity. So we have to see there are several models of compensating the employees, especially in case of startups. In the initial phase, the main issue is the capital and how much capital they have. They cannot go on paying the high levels of salaries. So one of the ways to attract the employees there is that, especially in case of startups, is that sweat equity. That means the people with high level of intellect, when they're joining you, definitely they might be bringing along with that a lot of value addition to the company. that value addition, what they are bringing, it may be in the shape of IPRs, or it may be in the shape of their all other value additions which are there for the benefit of the company. So that point of time, the company may offer a part ownership to that kind of prospective employees. That is called as sweat equity. Most of the time, sweat equity, you don't need to pay anything in lieu of, that means for consideration other than cash. The equity which is issued, that is called as sweat equity. That means against the sweat of yours, which may be in case of value addition, which may be in the shape of an IPR, in the shape of anything else which you are begging for the benefit of the company. The securities what are issued is nothing but a sweat equity. As far as the employee stock options are concerned, it is slightly different to that of sweat equity. Employee stock options, most of the times you have to pay for that. It is not that something what you are earning. You have to pay for that. When you have to pay for that, it may be on the fair value of the share in case of listed companies, on the price what it is listed on the stock exchanges. It may be equivalent to the same price, or it may be at an amount of discount. Okay, suppose that discount may be about 5-10% of whatever your fair value or market price is concerned. Primarily, this is the difference, and what are the nuances of sweat equity and ESOPs, that we will discuss when Jaswin is making her presentation. So I give a pause here and request Bala to give his open comments. Thank you.
Good morning to all of you. I have a great pleasure as usual to see you all on Saturday morning session. The topic has been well explained by our earlier panelists and also our Sudhakar. But only thing I would like to say here is the difference between the sweat equity and the employee stock option Sudhakar has actually explained. The sweat equity is actually coming for the efforts which have been actually put in by the people initially to contribution made by them in order to recognize and reward their contribution. Because people bring the money, they will put the money. One thing is developing the business, putting the contribution, getting the things done, strategy, working, all those things, a lot of efforts which have been actually put up. So this is the way of non-monetary reward given to the people so that it creates, a sort of a ownership interest. It creates a further interest to put in the more efforts and to develop the company. That is where the sweat equity comes here. And as for the employee stock option is coming, these are all of the way of, rewarding the people, retaining the talented people to bind with the company, because nowadays it is not only getting the good people, but also retaining them becomes a problem. So how to retain the better people? So it's one of the way the perquisite has been actually designed in order to give them the employee stock option. In fact, today we are going to discuss the employee stock option. There are many employee stock options also there, because I think our panelists also will be touching upon, because there is something called the ESOP, there is something called the ESPP, and there is again something called the RSA that is restricted or something like that. Then again stock appreciation, right? There are many ways of doing it. But the only thing is, as we are a company secretary, we are working with the unlisted companies and as well as the listed companies. The regulations governed by the listed companies as well as the unlisted companies are actually much different, and the procedure we have to follow. Under the Companies Act, everybody has to follow under the Companies Act. All the companies are registered under the Companies Act. But when it comes to the listing regulation, there are certain guidelines which are actually there by virtue of the capital market regulator. How do we go about the valuation? What is the things? All those things. How do the procedurally things also what is to be done? All those things are all there. I think Jaswin is actually going to take us upon all these issues, and I think she will definitely update us what is the difference between the listed company and listed company when it comes to the procedural issue of it. It's a very quite knowledge learning session I'm looking forward to here. As Dipti has already said, you can put up your questions on the chat box. We will answer then and there as and when the presentation takes place, whatever is relevant at the appropriate time. At the end, and we'll be allow you to speak to you. We can answer the question also at that time also. I think with this, I hand over the mic to Jaswin. I'll ask Jaswin to commence the presentation.
Thank you so much, sir. A very good morning to the esteemed panelists, seniors, colleagues, and the valuable participants. At the outset, I would like to thank the firm for giving me this opportunity and the participants for investing their time into this. I'll just share my screen and start the presentation right away. Yes. So our topic for today's webinar is sweat equity shares and ESOPs, as the panelists have highlighted and given an introduction on. We begin with sweat equity first. The evolution of the concept of sweat equity shares was first employed in the United States by cooperative societies for real estate projects, where the owners used to invest their time, the rates of the real estate projects used to go higher, recognizing the value and effort and commitment of the owners to it, hence known as sweat equity. In India, this concept got introduced through Section 79A of Companies Act 1956 and is now captured under Section 54 of the Companies Act 2013. So what are sweat equity shares? Section 2, subsection 88 of the Companies Act 2013 specifies that sweat equity shares are the equity shares issued to the company's directors or employees at a discount or for consideration other than cash for the purpose of providing know-how, making available rights in the nature of intellectual property rights, or value addition. So the question lies, who are entitled to sweat equity shares? The Companies Act and the rules made thereunder define employees for the purpose of sweat equity as permanent employee of the company who has been working in India or outside India, director of the company, whether a whole-time director or not, and any employee or director as mentioned above of a subsidiary or a holding company of the company in India or outside India. The term value addition has been specifically defined in the rules to mean any actual or anticipated economic benefit that can be derived, is already derived or is to be derived by the company from an expert or a professional from and for providing know-how or making available rights in the nature of intellectual property rights, for which compensation is not paid to such an expert or professional or not included in his normal remuneration payable by the company. This would mean would fall under the ambit of value addition. The procedure to be followed for the purpose of sweat equity shares issue depends on the type of company. So in case of companies listed on recognized stock exchange, the SEBI share-based employee benefits and sweat equity regulations 2021 shall be applicable. And in case of unlisted company, Section 54 of Companies Act, read with Rule 8 of Companies Share Capital and Debenture Rule 2014 shall be applicable. Since this is the masterclass in Companies Act, we will limit our today's webinar to the Companies Act aspect only. In case of sweat equity shares being issued to foreign employees or directors, it is of course, the FEMA Act shall also be referred, and any sectorial specific regulation shall be referred. Today, our view is only on the basis of Companies Act. So the process.
Just 1 minute. Just when you clarify to the participants, what is the sectoral regulations also, that if it is NBFCs, like that.
Right. So in case of NBFCs or insurance companies, their particular RBI regulation or IRDA regulation has to be referred to in such a case. The process for issue of sweat equity shares as per the Companies Act, the nomination and remuneration committee approval wherever applicable. So wherever the company is required to constitute such committee and the sweat equity shares are being issued to the directors, in such a case, the NRC approval shall be required. The board meeting shall be convened for the approval of sweat equity shares and for calling shareholders meeting. A valuation report shall be obtained for the valuation of the shares and to value the intellectual property, know-how, or value addition that is provided or against which these shares are being issued. The shareholders' meeting shall be convened for obtaining approval by way of special resolution. The filing of Form MGT 14 for the special resolution that has been passed by the shareholders This shall be filed within 30 days from the date of passing of resolution. Thereafter, a board meeting shall be called for allotment of the sweat equity shares, and pass 3 shall be filed with the registrar of companies within 30 days of such allotment, and an entry for the sweat equity shares shall be made in the register for sweat equity shares in the format SH3.
Just 1 minute, this way, please. 1 minute. Yeah, sorry. Go ahead, Bala.
Someone is putting a question. Can the sweat equity
Bala,
share
Bala, 1
also
minute,
be-
1 minute. Bala, 1 minute. Let us take the questions. Let Jaswin go in the flow for some time. After that, we will take up the questions. Okay.
Okay.
And Jaswin, go to the previous slide, please.
Sure, sir.
No, not this one. Next. Yeah. So whenever the company is contemplating for issue of sweat equity shares, as Jaswin has rightly mentioned, in case there is a nomination and recommendation committee, the board has to, that is to be routed through NRC committee, and NRC committee has to devise the model of issuing sweat equity shares and compensation. So a thorough discussion is required that in how many sweat equity shares are to be issued to whom, and similarly, whether they are to be at the discount or at for consideration other than cash. All these aspects are to be discussed by the NRC. After that, once they decide that yes, we have to issue it and the valuation of that shares are to be arrived at, then in case the company is having an audit committee, then the audit committee will come into picture for appointment of a registered valuer and valuation of the shares, whether that valuation has been correctly done or not done. The audit committee has to play a very, very crucial role. Once audit committee agrees on that valuation of the shares, then both these committees have to put up the proposal with their recommendations before the board of directors. Then the board has to approve the issue of sweat equity shares and whatever the other, again, to whom, how many issue, how many have to be issued and all those things. As per the NRC committee's recommendation, the board has to approve that. So wherever you have nomination and recommendation committee and wherever you have audit committee, and these two committees are to be brought into picture, and with their recommendations only board can move further. However, in case these committees are not there, then obviously the board has to play the entire role. The board has to play the role of NRC also, board has to play the role of audit committee also, and board has to play its own role also. Yeah. Yes, Bala, go ahead, please. Yeah, just wait. Whichever is the
No, we said we'll take the question little later.
Yeah.
So,
Questions, let her go for some time, or let her complete the sweat equity and then we may do it. Because otherwise, what will happen is again we will get into the questions only. Yeah.
Let her get the sweat equity share completed, then we'll take the proposal. Yeah.
Please.
Thank you for your input, sir. So the question is, what would be the contents of the explanatory statement in the notice convening the shareholders meeting for the purpose of the special resolution? So the rules mention that the explanatory statement shall mention the date of the board meeting at which issue of sweat equity shares was approved, reasons and justifications for such issue, the particular class of equity shares that are going to be issued, in the form of sweat equity, total number of shares to be issued, the class or classes of directors or employees to whom the shares are to be issued, the principal terms and conditions for sweat equity shares, including the valuation, the time period of association of such director or employee who is being offered the sweat equity shares with the company, the relationship of the director or employee with the promoters or KMPs. This is to capture any kind of interest or underlying interest with the promoters or KMPs of the directors or employees. The price at which the sweat equity shares are proposed to be issued. Consideration, including other than cash consideration, if any, that is to be received by the company. The ceiling on managerial remunerations and calculations thereto, specifically when it's included in the form of managerial remuneration, the calculations under 197 and 198 of the Companies Act as well. Diluted earnings per share after the issue of such sweat equity shares as per the accounting standards. The other conditions that are to be taken care of during the issue of sweat equity shares is the special resolution authorizing the issue shall be valid for a maximum period of 12 months, which means that the allotment of sweat equity shares shall be done within 12 months from the date of the special resolution passed by shareholders. The company can issue sweat equity shares for a maximum of 15% of the paid up equity share capital in a year, or shares of the issue value of rupees 5 crore, whichever is higher. It is worthy to note that the rules mention in a year and not particularly financial year. The third is issuance of sweat equity shares shall not exceed 25% of the paid up equity capital at any time. But in this case, startups are given a higher limit of up to 50% of paid up capital up to 10 years of their existence from their incorporation. The lock-in period for sweat equity shares shall be 3 years from the date of allotment. And in case there is a need for issue of share certificates or any other form, then the lock-in shall be particularly stated on such shares. And even in case of dematerialized shares, the lock-in should be specified to the depository. Valuation shall be by a registered valuer for the fair price, as well as valuation shall be required for the valuation of the intellectual property, know-how, or value addition provided. A gist of the critical elements of the valuation report shall also be annexed with the notice convening the shareholders' meeting. The amount of sweat equity shares issued for consideration that is other than cash and which does not include any addition to the assets of the company to be carried in the balance sheet shall be created and shall be treated as managerial remuneration under Section 197 and 198 of the Companies Act.
Yeah, just 1 minute, just wait. Well, I think at this stage you can take up the questions because whatever information to be furnished in the board's report is a procedural part. Now you can take up the questions.
Okay. Can the sweat equity share be issued to the director or employee who are also in the promoter category?
As such, there is no prohibition on issue of shares to the promoters as far as sweat equity shares are concerned. In case of employee stock options, you cannot issue to the promoters, but such restriction is not there for sweat equity shares. You can issue to the promoters.
Yeah, you're absolutely right, because it is basically the efforts of the company which has been put there. So specifically, it is not there, it can be. Yeah, you're right, absolutely. Can a company issue the share to the CEO as a compensation for his efforts through his know-how may not be valued? Now, the moment you say the compensation, this is nothing to do with the sweat equity with the compensation. That first line itself, it is there.
No, as Jaswin has rightly mentioned, when you are issuing sweat equity shares to your directors or senior managerial personnel, as I told you, especially in the initial phase of the startups, they don't have much of cash with them, the funds with them to compensate the employees. So if the CEO compensation is compensated by way of issue of sweat equity shares, it's quite possible you can do that. But the only thing is, in such case, what happened is the accounting treatment will be slightly different. If that CEO or the directors to whomever you are issuing the sweat equity shares, if they are bringing any kind of IPRs with them or any kind of value addition with them, which you can capitalize, then it will go to the balance sheet. Suppose he is not bringing anything, but part of his compensation is being paid by way of sweat equity shares, then it is to be routed through profit and loss account. And as Jaswin has rightly mentioned, it is a part of his compensation, which is a managerial remuneration. If he is a manager or a director, then Section 197 gets triggered. That compliances need to be ensured. That 5%, 10% limits. Otherwise, you have to go for a special resolution from the shareholders. All those issues will crop up there. So you can pay the compensation of the directors or CEO or manager also by way of sweat equity shares. There is no bar on that.
Yeah, you're right actually, but only thing is it goes as a managerial remuneration only, as you rightly said. Yeah. Then the next question is, for certificate share, if the valuation rupees 1,000 for know-how, then the company issue the share at 2,000 rupees, that is at a discount. I'm not clear about the question what he is asking. For certificate issue, if the valuation rupees 1,000 for know-how, then can company issue share at 2,000 rupees? And again, you're putting at a discount.
At a discount. Yeah. Yeah, that question is not clear. But typically,
Yeah,
if you
because when you say 1,000 rupees is a, yeah. Yes, Satya.
Yeah, see, so long as you're valuing services and you have a valuation report to justify the share price, I think, it is good. Whether you can do it at a discount to the value is again determined by your discount rules. So I was not sure of the question that you're asking. Maybe we can take up the next question.
Valuation report of the registered valuer or merchant banker as it is required.
See, typically company law requires RV, but your income tax requires MB. So, in modern day today, companies are being asked to take both and keep it. But if you have a MB valuation certificate that you have taken in the recent past, which is of the same price, a RV valuation should suffice for issuance of these.
Can certificates share be issued before the IPO?
When you say before IPO, are you referring to an unlisted company or after filing DRHP, before filing DRHP, or
when you are talking IPO, then it means it's unlisted because initial
unlisted
public
you
offer.
can issue? Exactly. Or if you have already filed a DRHP, then obviously no, because your DRHP is filed unless you have disclosed in the DRHP that you're likely to issue this. So I don't know the timing, but if your question is, can it be issued for unlisted companies? The answer is yes, you can issue it for unlisted companies.
Can the register SH3 be maintained in Excel? I think this we have talked about it many times, but maintaining the register will definitely call with the time-stamped machine. It is governed by the regulation. Just to maintain the Excel sheet and all this thing is not having the legal sanctity. Correct, no, Jasmine?
Yes, it should have a timestamp and any kind of editing should also be captured. There's specific softwares for it. Yes.
Oh, 1 minute, 1 minute. See, if you are maintaining the statutory records in electronic form, then it is different. If you are maintaining the statutory records in physical form, then it is different. So if you are maintaining your statutory records in physical form, you can maintain it in Excel sheet. What is the problem? Unless until you are maintaining your statutory registers in electronic form, the timestamp requirement will not be there. If I am not wrong, the question from the participant is they must be maintaining the records in the physical form. In such case, Excel format for maintaining. Only thing is that SH3, whatever the particulars are there, those particulars are to be there. Yeah.
And I think just to add, anytime somebody asks you for a copy of it, then you probably have to print it, get it signed by the relevant people against the entries and provide a scanned copy and not just send an Excel. I think that's the only difference because you're still maintaining it in physical form broadly and not in the electronic form.
In fact, I'm sure the participants are aware of this. Just for the sake of clarification only, I'm mentioning this. Maintaining the registers in physical form does not mean you have to have a paper with you. If you are maintaining it on your laptop, as and when required, you are taking printouts and keeping it with you. That is called as maintaining the records in the physical form, whether it is the minutes or whether it is the other statutory records are concerned. Company has an option to maintain the statutory records either in physical or in electronic form. The board has to decide in case they want to maintain it in the electronic form or whatever the form it may be. But once you decided to maintain electronic form, you cannot switch over to physical and electronic like that.
Yeah, you are right, absolutely, Sudhakar, because when you say physical form. Physical form also can be maintained in the computer, but the problem is it should be available as and when it is called for by the authorities. That is the only requirement is there. If you are maintaining it, if the authority calls for it, you are getting into the mode of searching mode and other thing and all, not able to find out, etc. and other thing and all, that creates a problem there, because that is the only requirement. Easily accessible, available at any point
See,
of time.
in fact, let me also clarify one more thing. When you are maintaining the statutory registers in a physical form, say for example, in case of minutes, under section 118, there is a requirement that you have to record the minutes within 30 days of the board meeting. Once you finalize the minutes within 30 days, you have to engross the minutes on the minute sheets, take the printout and you have to keep it. Then only it is called as maintaining the minutes within 30 days. Whenever suppose an ROC comes for inspection, and if we ask you, show me the minutes of the latest board meeting, when you say it is there in my laptop and I will take a printout and will show it to you, that is not in compliance with section 118. Earlier also I clarified this at whenever I was talking about Secretarial Standard 1. Similarly, in case of other statutory registers also, say for example, section 186 register, within 7 days, the entries are to be made in the statutory registers and have to be maintained. Means what? You have to take the printouts of the statutory registers from time to time. When the ROC comes, you cannot go and take the printouts. You have to keep the printouts within the given time limits. Okay? That is what is called as maintaining the records in physical mode. Yeah.
Thank you, Sudhakar. You are amply clarified. Can you explain the condition of a 15% and 25% again? When is which percentage is applicable?
Just when you can explain this.
Yes. So basically, what's the difference between 15% and 25%? It's 15% of the paid up equity capital in a year. That is the yearly limit, and 25% in total. So it should not, over the course of years, it should never exceed 25% of the paid up equity capital. But the limit for a year will be 15%. That's the difference.
Just to clarify it for 1 minute, Bala, just to clarify it further. Suppose if your paid up capital of your company is say 1 lakh rupees, and in the financial year 24-25, now you have decided to issue sweat equity shares. So you can give 15% of your paid up capital. That means up to rupees 15,000, you can issue the sweat equity. Next year, again, you want to issue the sweat equity shares. So that point of time, you have to see that 15%, again, you can give it, that is 15,000 rupees, but it should not exceed 25% of your paid up capital. So 25% of your paid up capital is what? 25,000 rupees, out of which already you have issued 15,000. So next year, your limit is only left out is 10,000 rupees. That is the ceiling. Then the third year, you cannot issue any sweat equity shares at all, unless until you increase your paid up capital. So always issue of sweat equity shares is linked to your paid up capital. Normally what happens is in the startup companies and all, the capital flow is always used to be there. Some private equity investor comes or some angel investors come, they go on pumping the funds into the company. That's how the limits always fluctuates. Okay. Yes, Satya, if you want to add further anything to this.
No, I think good. I think you had given pretty good example and clarity on this.
Okay. I think there was one question, in fact, that we have not answered properly. That is, for sweat equity issue, if valuation is rupees 1,000 for know-how, then can a company issue shares of rupees 2,000? I'm actually presuming this question like this. Suppose when the valuer is arriving at the fair value of the share of the company, that is coming to say that means the fair value of the share is 1,000 rupees. Whereas the face value of the share is 10 rupees only. So 10 rupees share, you are issuing at a face value of rupees 10 share, which is
Premium.
worth rupees 1,000. So you are issuing at a premium.
Correct.
That is how it is to be done. So this issue of 2,000 rupees will not come. That question is not there. Okay. Because we don't have face value shares of rupees 2,000. But suppose, for example, if at all that company is having a face value of rupees 2,000, because nowadays there is no restriction as far as face value is concerned. And especially in case of a private company, you can have face value of rupees 2,000 also. But if your fair value is 1,000 rupees, how can you issue a face value of rupees 2,000?
See,
Maybe one can say it is a discount. Answer is correct, because what this gentleman is asking is, my face value of the share is rupees 2,000, but fair value is only 1,000 rupees. But provided your employee is going to take that, you may call it as a 2,000 rupees value share or a 5,000 rupees value share, but your fair value is 1,000 rupees. Which employee will take that sweat equity? Nobody will take it.
No, no,
This
I
is how
have a question for you. I'll just
Yeah.
add to that question. Okay, let's assume that the know-how that has come into the company is worth only 1,000 rupees. Okay, but I want to give to this person for 1,000 rupees I got shares worth 2,000 rupees. Forget par value, premium, everything. Okay, somebody gave me in the manner of know-how 1,000 rupees, but I want to give them shares worth 2,000 rupees. I think that question, if you know, and which is why I didn't want to, assume. The question is, can I receive 1,000 in value and give 2,000 rupees of shares? Is that
Yes.
possible?
Okay, that also I can answer that question. Suppose,
Yeah,
for
that's the
example,
question if I'm wrong.
okay, great. Okay, if that is the case, okay, this is another permutation comment. This is another what's called dimension of the question. If at all it is there, suppose, for example, I am getting, say, suppose any asset value which is 1,000 rupees, as against that I am giving rupees 2,000. Can I do it? Answer is yes, you can do that. Only thing is the accounting treatment, how it will be. Accounting treatment will be 1,000 rupees will be routed through balance sheet, and 1,000 rupees will be routed through your profit and loss account. Because what the asset you are getting is only 1,000 rupees worth. So 1,000 rupees worth will go to the balance sheet. And another 1,000 rupees you will show it as an expenditure part only. That is maybe as a compensation, maybe you can do anything else. As far as accounting treatment is concerned, it is to be split into two. You can issue by all means. Why not?
Yeah, I think that's the question. I mean, there are other nuances then, and you might get impacted by tax laws or some other laws.
Yeah, those are all there. See,
Those are all there, those all exist.
Correct.
But straight away. But do you want to do it as a discount? Then doing it as a discount might put you in a different trouble. But if, like Mr. Sudhakar said, if you're routing through P&L, that's probably the most easiest way to route it and get it into the system.
In fact, in one of the forums, I have been asked a very interesting question. Of course, that question is not here, but I just recollected that. The question was, can we issue preference shares, okay, which are convertible in nature as sweat equity shares? Number one, first question is convertible preference shares. Second question is preference shares as such, can I issue? According to me, though that we call it as sweat equity shares, there is no bar as such, according to me, when you are issuing preference shares in the shape of sweat equity also. But the only question there is, sweat equity always gives you a ownership. Then only people prefer that, and that is the reason when this was conceived, this idea was conceived as sweat equity shares. Equity is a ownership. Whereas in case of preference share, there is no ownership. Preference share is what? You are getting some money and you will be giving it with a coupon rate after some time. So sweat equity shares and the preference shares, there is no prohibition as such, but that model can't be visualized. But yes, convertible preference shares you can conceive. In fact, initial phases, what happened is the promoter may not be very much interested in diluting his voting power. When he is not in a position to dilute his voting power, that point of time, he can always say that, look, I will give you a convertible security document. That convertible preference shares I will give you, which I will convert it into this thing after 1 year, 2 years, 3 years, whatever you may, that, okay, that this thing is there. Possibility is there. One has to always see the tax impact, because ultimately at the end of the day, what the employee looks for is what I am going to get the benefit for what I am about the amount of sweat what I am giving to the company. So it should not end up that that huge tax liabilities are there on the employee, because in this sweat equity issue, liabilities on the employee only, nothing, not a single rupee on the company. So proper tax planning is required. And then another issue is that when you are issuing sweat equity shares, if you see that what Jaswin has mentioned, in the shareholders approval as well as in the board approval, what sort of information you have to furnish. Because the clarity should be there to the company, what I am giving, and to the employee, what he is getting. Both are to be at the same, what's called level. What I am giving you and what you are getting should be at the, proper understanding should be there. It should not get into a trouble tomorrow. Because what will happen is, if the employee is not having the clarity of what he is getting, net of taxes, tomorrow, suppose an expert is there. He may say, look, you never told me that it is net of taxes. Where the clarification is there? As far as I am concerned, $100,000 I have to get it at the end of the day. Now you are telling me as per your tax laws, you have to pay this much tax and you are going to give me only $70,000. He may not accept it. That will lead to a dispute. And that will be disastrous consequences as far as that startup is concerned in the initial phase itself. So this is what one has to be very careful about. Yeah.
And just to add to, just to have one thing. So when you referred preference shares, they cannot be redeemable. You can do preference shares, but I think they shouldn't be redeemable. They should still be convertible into equity and you can convert them probably. Is that what you meant?
Because preference shares in perpetuity, you cannot give it. There is a time limit is there. I think that 10 years
20
or 20 years,
years.
whatever.
20
20
years,
years
yeah.
time limit is there. If it is infrastructure companies, another 5 years, you can add up to that. But what I did said is that, yes, preference shares, but the question what somebody has put me in a forum was,
very good
can
point.
we
That
issue
is,
preference shares in the shape of sweat equity? Yes. If you
yes.
don't want to get your voting power diluted in the initial phase, you can issue a convertible document in the shape of convertible preference shares. Number one.
Absolutely.
Number two, if the employees are ready to accept preference shares in the shape of sweat equity, it will
Why
be
not?
beneficial to the company always. It will be a loss to the employee concerned because there won't be any capital appreciation there. He will only get a coupon rate, that also provided it is cumulative. Otherwise, he won't even get the dividend, whatever it is there. If it is a non-cumulative preference share, if there no profits of the company or management not declared dividend, you won't get anything. So that means what? 5 years before, if I told you that I will give you 100,000 preference shares of rupees 10 each, that means 10 lakh rupees I will get it over a period of time. The rupee value is falling, inflation, because of inflation. Ultimately, what you are getting, nothing. Yes, if you want to bluff your employees, if the employee is a that kind of a person, if he accepts it, the company can by all means do it. There is no legal bar on that.
But Sudhakar,
Yes.
little bit my view is that it is mentioned very clearly sweat equity, and there is a difference in equity and preference, say, for in the inheritance only as shares. So in this scenario, I think this is little ticklish issue.
I agree. That's why I'm
I
telling you.
feel
But at the
that
same point, but one
I
minute,
have
Deepti.
my view different, so that's why I say that it's to be kept open.
I do appreciate, but they are not, no bar is there in the Companies Act. See, what happens is, but the general law, unless until it is prohibited, you can do it. Say, for example, when HLL, when they conceived a bonus issue of debentures, it is always say bonus shares only in the book, in the rule book. They never say bonus debentures, but ultimately bonus debentures were issued. So similarly here also, it was a hypothetical question. Can we issue preference shares in the shape of sweat equity? For that, my hypothetical answer would be there is no bar as such, but whether it is practicable, whether it is pragmatic, so far, no, it is not tested as such. It can be tested. That is what my view.
Okay.
Yeah.
Okay,
But
next
yes,
question.
as far as the convertible preference shares are concerned, sir, I'm sure that you will agree with me. It can be done.
No, still not.
Okay, no issue. It's always good to have a diversified opinion.
Yeah.
The definition under 288 says that equity shares are an
Yeah,
issue.
I know. We will. That's why I park it now. It's a debatable thing. We will end it
See,
otherwise
now
here only.
the new twist in the company law is equity securities versus equity shares, right? And that's what we are all trying to read between. What are equity securities and what are equity shares, right? But I think that's more of a, if you ask me, that's more of a, I don't think it is used consistently across. That much I can tell you. Yeah, go ahead. Next question, or we can move to the next slide. I think there was one question, that can it be issued to consultants? I don't know if that question was already taken up.
Bala sir, I think you're on mute.
Okay.
Yes.
I think another question which is asked is pertaining to ESOP. I think he is asking the valuation, grant stage, vesting stage, exercise that you are
Yeah,
going
that
to
we can
discuss anyway
cover.
later.
Yeah, absolutely.
15%, 25% post-issue, pre-issue. I think this has been amply clarified. I don't know why again it is being asked. Sudhakar has given a very good explanation on the 15% and 25%. In my view, paid up capital should be of significant amount, say 1 crore or so. I don't know what he wants to say actually. In my view, paid up capital should be significant amount, pay 1 crore or so. Is he
I have
referring to
given
the
an
data.
example. I have given an example.
Yeah.
1 lakh rupees, I have given an example. It can be 1 crore, it may be 100 crores, it is a different thing. I have given an example just to explain that. Okay, 1 lakh rupees, 15%, 15,000, 25%, 25,000. That is a ballpark figure. I have taken it for the sake of explanation. That doesn't mean a company is having only 1 lakh rupees and they are issuing sweat equity shares. It's never possible.
15% and 25% is the calculation on the basis of total paid up equity share capital.
No, that's Jasween's message to response to the question.
Yes,
Okay.
Pre-issue, post-issue, yeah.
Okay. Can ESOP be routed through trust? That is coming later, I think so. That we need not discuss. I think that's all. You can move on, Jasmine.
Sure. Thank you so much. The particular disclosures required to be made in the director's report after the issue of sweat equity shares are the reasons and justification for the issue, the class of the shares, equity shares that are issued, the total number of shares issued showing the number of such shares issued, and particularly the shares issued for consideration other than cash. The individual name of allottees holding 1% or more of the issued share capital after such sweat equity share issue. The class or classes of directors or employees to whom the shares are to be issued, are issued under the sweat equity share scheme. And the principal terms and conditions, including valuation. Further, the director's report shall also disclose the total number of shares arising as a result of such issue, percentage of sweat equity shares as a percentage of the total post-issue capital of the company, the consideration including consideration other than cash is received or benefit accrued to the company, which shall also include the value addition points, and the diluted earning per share after such issue. The register of sweat equity shares shall be maintained in format SH3 that had been discussed earlier as well. It shall be maintained at the registered office of the company or any other place that the board of directors may decide. And the entries in such register are to be authenticated by the company secretary of the company or any other person authorized by the board on this behalf. Particular case law relating to sweat equity shares is Gateway Distriparks Limited and others versus Ranjiv Kumar Bhasin. It is a Bombay High Court judgment wherein they stated that any call option with the issuing company after issue of sweat equity shares shall be held to be invalid. That is, once the sweat equity shares are issued and the lock-in period is completed, the company does not have a right to call back the sweat equity shares from the holder.
Before you switch over to employee stock options, I don't remember whether you covered this or not. In case of startups, they can issue the limit is as against 25%, it goes up to 50% of the paid up capital.
Covered.
They can issue sweat equity shares. I'm not very sure whether you are covered.
Yes, point
If
3
you are
covers
covered,
that.
it is fine.
Yeah, she has already covered, I think.
Okay,
she has already
correct.
given in the initial slide.
Good.
Can I move on to employee stock options now?
Yeah, sure.
Yes. So the second part of the webinar deals with employee stock options. The evolution of the concept of ESOPs. So Louis O. Kessler was the first person who created the employee stock option plan. It originated in USA. In Russia, the average ownership by non-management employees is 55% to 65%. This is giving a global purview on ESOPs. In China, several local governments have sold most of the enterprises to the employees by way of ESOPs. England follows the same law as US for the purpose of ESOPs. What is the main objective of ESOPs? It is to ensure that the employees are committed and they feel a sense of ownership towards the company. Ensures additional wealth for the company, for the employees of the company, and supplement their retirement and social security benefits. It helps the company, especially new companies and startups, attract talent and high valued professionals, and helps retain the employees or specific skill holding groups. What are employee stock options? Section 2, subsection 37 of the Companies Act defines employee stock option as an option given to directors, officers, or employees of the company, its holding or subsidiary, which gives such directors, employees, or officers the benefit or right to purchase or subscribe to the shares of the company at a future date at a predetermined price. Who are the employees and what is the ambit of the term employees for the purpose of ESOPs? So it covers permanent employees of the company working in India or outside India, the director of the company, whether whole-time director or not, excluding independent directors, and any such employee or director of the company, its subsidiary company or holding company, whether in India or outside India. However, there are certain classes of people who are excluded, particularly from the definition of employee, which is a person belonging to the promoter or promoter group shall be excluded for the purpose of ESOPs, and any director who himself or with his relatives holds 10% or more of the equity share capital of the company cannot be entitled to ESOPs. Particular famous types of popular types of ESOPs that are
Just 1
issued.
minute.
Sure.
Please go back to the previous slide.
Yes, sir.
So here again, please repeat
Start up.
this particular slide. Please explain it. There is some questions coming. I have seen in the chat box about consultants and all.
Yeah.
Who are entitled to it? Please explain once again. That will clarify to the question itself.
Sure, sir. So employee, that is who is entitled to ESOPs as defined under the rules, is a permanent employee of the company working in India or outside India, a director of the company who can be a whole-time director. However, it excludes independent directors. Any such employee or director of the subsidiary or holding company. And this definition particularly excludes people belonging to the promoter or promoter group, and director who himself or with his relatives collectively holds 10% or more of the equity share capital of the company. These two categories are excluded. But if we are talking about, so would you take up the consultants part of it in light of this definition?
So I want to just say here that it is very clear. Even if you are having a part-time employee, they are not entitled for. Whether a company can have part-time employees, answer is yes, they can have part-time employees. There is no ban as such. But employee means you should be a permanent employee. Temporary employees, even if they are there, they are not covered here. So it is explicitly mentioned that who are the people who are entitled for it. And similarly, if any permanent employees are there, but they belong to the promoter group, then they are not entitled for. Similarly, director who himself with his relative hold 10% of equity share capital, again the same thing, that if they are, though they are employees, they may not be entitled for. So we have to see very clearly who are the people entitled, who are the people not entitled. It is crystal clear, it is there. So consultants definitely are not part of the employees. So consultants are not entitled for ESOPs. And similarly, practicing company secretary, can he get a ESOP? Answer is no. Same is the case with sweat equity shares also. I think they are to be employees or directors. Okay.
Sudhakar, I want to ask one question to you. I have seen some of the companies, they actually employ the people for a fixed term. That
Correct.
is, they say that, yeah. In some
They
of
can
the
employees
companies,
for employees for
fixed term. Fixed term.
as a
Say
fixed
they
term,
apply
fixed
for
term.
3
Okay.
years.
Okay.
3 years. And it is actually mutually, renewable after 3 years. But they are in the employee, they are in the role, they are there everywhere. But only thing is their fixed term is only 3 years. What category they will come? They will come in the permanent category, temporary category.
See, it is a contractual employment. Okay. It is not and similarly contractual employment employees for all purposes, they are permanent employees only. They are employees. It is as per the contract. Say, for example, suppose, for example, when I am joining a company, it is very clearly mentioned there with 3 months notice, I can throw you out of the company. If I don't like you, that doesn't mean it is a temporary employment.
Sudhakar, some or other, I don't know, being a old timer, excuse me for asking this question to you. Being a old timer, I thought actually the person who's employed in a company, okay, the terminal cost, whatever you say, 1 month, 3 months, whatever the period is there, he enters in the company, he is actually on a probation period, but sometime after the probation period, he has actually made as a permanent employee of the company and he is retiring at the particular stage. That is what I thought it is coming under the permanent employee. What the employee actually complete his probation period, he is actually, confirmed in his services with the retirement age of the 60. He is a permanent employee. That was my understanding. So now I see very recently the people, they apply for 2 years, 3 years, and it is again subject to mutually agreeable. After 2 years, they change the employee, they bring somebody else. That also happened. That is why this person.
If I am not wrong, the difference between a person who is under probation and the person who is made permanent is the only difference is about the notice period.
Okay.
If I am not wrong, for all purposes, a person who is on probation also he is an employee only, and he is entitled for all the benefits which an employee is entitled for. And similarly, even under the Provident Fund Act or ESI Act or whatever it is, he is for all the purposes, he has been treated as an employee only. That's what my understanding is.
I completely agree with you. I think the concept here is permanent employee and not full-time employee, right? And today, if you see, a lot of companies are hiring employees on gig basis also. So the question is the contract for employment permanent? It could be fixed term, it could be not a fixed term, but is the contract permanent? And if it's a written contract, even for a fixed term, he will fall into permanent category and therefore eligible for ESOPs. Whereas a consultant on the other side is a consultant and not on the rules of the company and therefore is not eligible for ESOPs from that perspective. Also, there is an exception. There is just one exception again for a startup. If a company is a registered startup, they can issue ESOPs to promoters. That's an exception that is specifically given to startups. But again, you will have to make sure that that startup registration is valid. Very important. There is a bunch of criteria which you have to constantly fit into. If the company does not fit into that category, then though it has a registration, it cannot continue that registration. So at the time of grant of options, the startup needs to have a continually valid startup registration. And if that is the case, ESOPs can be given to promoters also.
This is a very ticklish issue because permanent employee means which are not permanent. Now, permanent, we say that as regards the permanent in the sense we have to connect it to the removal or discontinuation. How the discontinuation, I think if that discontinuation is checked, then the person is permanent because consultant and otherwise they can be removed. So honestly, I think it's a very detailed subject according to me, and also PF and other, employee benefit, how it will be treated, and then it can be analyzed. It will depend on many factual circumstances when we say contract employee. So Bala, I think many think that contract and all that we need to check what kind of contract, and then only we can bluntly answer this question. Because when you say it's a for temporary period on a contract, the contract has many limitations and conditions which may turn out to be not correct for ESOP also. Right, Mr. Bala and Sudhakar? It depends
Dipti.
on also the fact.
No, Dipti, if I am not wrong, if the contract between the employer and employee is an employment contract, then the employer-employee relationship is there, which is not there in case of a consultant. In the case of a consultant, the employee-employer relationship is not there. So the fundamental thing to understand whether a person is an employee or not, what sort of contract you have entered into. If it is an employer-employee contract, definitely it is employment only.
So the condition is first is of employment, then next is contractual or not contractual.
Yeah, correct.
Right? Yeah.
Yes. Employer-employee relationship is to be existed. That is very important.
Yeah, next. Go ahead, please.
And in fact, let me also add that if I am not wrong, even for the tax purpose also, it has been recognized that if it is an employee-employer relationship, then the taxation aspects will be different as for an employee. If it is a consultant, if that contract is for a consultancy, then it will be entirely different. It is not salary, it is a business income. So the same has been recognized even for the tax purposes also. Similarly, your TDS will be different. Your taxation, your what's called as the mode of income what you are getting is also different. Yes, Jaswin.
Yes. Certain popular types of employee stock options that are prevalent. First is, of course, the ESOP scheme, wherein the company grants an option to its employees to acquire shares at a future date at a predetermined price. Eligible employees are free to acquire the shares after the completion of the vesting period and within the exercise period. And they can dispose of the shares subject to the lock-in. The generally exercise price is lower than the prevalent market price in this case. Second form of structure is employee stock purchase plan, this is generally used by listed companies, wherein employees are given the right to acquire the shares of the company immediately at a lower price lower than the market price. However, the shares are subject to lock-in. As a result, the employee cannot sell the shares and the employee has to continue with the employer for a certain number of years. The third is the share appreciation. Yes, sir.
The employee stock option purchase plan, it is always linked to the IPO of the company. Okay, when the company is coming with a public issue, that point of time, certain percentage of the proposed equity is reserved for the employees of the company on a firm allotment basis. And sometimes it may so happen, there may be a variation in the price also. There may not be a variation as far as the IPO price is concerned. So in the normal circumstances, employee stock option purchase plan is not there. Okay. That is always to be linked to the IPO of the company.
Right. The third model is the share appreciation rights, which is in this structure, no shares are particularly allotted or offered to the employee. However, the employee is given the appreciation in the value of the shares between two specified dates. So the difference between the price of the shares on these two dates would be given to the employee as a sign of incentive or performance bonus. This is linked to the performance of the company as a whole due to the change or increase in the share value. Certain important terms linked to ESOPs. ESOP scheme document is the core document outlining all the terms and conditions of ESOPs. The drafting of this document is very crucial for the purpose of ESOPs. ESOP pool is the portion of companies' equity shares allotted for the purpose of ESOPs. Grant means the process of selecting specific employees, typically based on their roles and performance, to receive these stock options. It is basically the act of offering stock options to the eligible employees, known as grant. Grant date means the date on which the company allows the ESOPs to the employees. Exercise price is the discounted price at which employees can purchase the company's shares after the completion of the vesting period at a future date. Expiry date means the last date available for the employees to exercise their options, after which the options shall lapse. This is the time period when this is the date that they get, last date for the conversion of options into shares. Vesting is the period between the grant of the options by the company to the date when the employee actually becomes eligible to exercise the options on ESOPs. Exercise period means the period during which the employees can exercise the option, the ESOPs, and purchase shares against the options given to them, after which the options shall lapse. The spread or discount means the difference between the fair market value of the shares on the exercise date and the exercise price of the shares. This is the actual benefit that the employees get out of the ESOP issue. So particular stages of the of ESOPs is grant, when the company mentions or grants the right to the employees. Second is vesting. That is the time gap between granting and vesting, when the employee actually becomes entitled to exercising such options. And the last is exercise, which is on the intimation of the employee, the options get converted into shares then. So these are the three crucial stages of ESOPs. Procedures to be...
1 minute,
Sure.
just please go
Sure.
for it. See that how the ESOPs operate is as rightly mentioned by Jaswin. Just go back to one more previous slide, Jaswin. Before that. Yeah. See, the first and foremost thing is that ESOP scheme. That ESOP scheme is to be devised. As I told you that even in case of ESOPs also, if you are having a nomination and recommendation committee, it is mostly the responsibility of the NRC committee to devise the scheme of ESOPs. Once the ESOP scheme is devised, and then of course, obviously the approvals of the audit committee, if it is there for valuation of the shares in case of closely held company, arrive at the fair price, and the board approval is required. Then it depends upon the companies whether to give a discount to the fair value of the price. And similarly, in case of listed companies also, whatever the market rate is there, they may give a discount or they may not give a discount also. And what is the advantage for the employees? In fact, several times this question also comes up. Say, for example, if RIL is giving a stock options today, and if the today's market price is say 3,000 rupees, and RIL might be deciding it, okay, the predetermined price is 3,000 rupees. And then the employees are going to get that thing, and whatever the grants are going to be there, which are to be vested and exercised over a period of time. Somebody may ask a question that why I have to go for ESOPs? What is there in store for me? Why can't I purchase it from the market itself for rupees 3,000? The answer to that is, once ESOPs are granted to you, they will vest after 1 year, as Jaswin has mentioned. There should be a period of 1 year before granting and vesting. Once it is vested, you can exercise that over a period of time as per the scheme, and normally it is 4 to 5 years period is there. That is called as exercise period. During this exercise period, at any point of time, at your convenience, you can avail what's called exercise the option, and the company is obligated to allot you the shares, whatever you are entitled for. That point of time, this 3,000 rupees, which is predetermined price, the market price of the share may be 5,000, 6,000, or whatever it may be. That is the advantage to the employee concerned. God forbids, sometimes it may so happen, there may be a market crash. At that point of time, the 3,000 rupees share value might have come down to 2,000 rupees. But the market is not going to be stagnant for 3 to 4 years, because you have the right to exercise the options over a period of 3 to 4 years. So market may not be good today, but it may be good tomorrow. And once you got the shares exercised and you have been allotted, you can always sell the share subject to the insider trading regulations. About the contra trade, only you have to ensure that, otherwise you can sell it. That is why advantage of this thing. Yeah. Go ahead, Jesse.
Yes. The procedure to be followed on the basis of the type of the company. In case of companies listed on recognized stock exchange, the SEBI share-based employee benefits and sweat equity regulations 2021 has to be followed. And in case of unlisted companies, section 62(1)(b) of the Companies Act, read with Rule 12 and 16 of companies share capital and debenture rules 2014 has to be followed. Additionally, in case of issue of such equities, such ESOPs to foreign employees of the company, the Foreign Exchange Management Act has to be referred. And again, in case of NBFCs or any other where any other sector-specific regulations are applicable, they have to look into same as well. Today, our scope of discussion would be limited to the Companies Act and the rules made thereunder. Procedure, the broad procedure for issue of ESOPs shall be first creating an ESOP policy, the calling of the board meeting for approval of the scheme and for convening the shareholders meeting, valuation of options wherever required, that shall be taken care of, shareholders meeting for obtaining approval by way of special resolution, grant of options to the identified employees, filing of MGT 14 within 30 days of the special resolution. Upon grant of options, the beginning of the vesting period, and upon the completion of the vesting period, the beginning of the exercise period, wherein the employee shall get the right to exercise their options. On the basis of the exercise of options by the employees, calling of the board meeting for allotment of shares, and filing of PAS 3 within 30 days to the registrar of companies thereto. Thereafter, the entry of the ESOPs in the register maintained for the same in the format of SH6. The compulsory contents of the explanatory statements, explanatory statement to the notice convening such shareholders meeting for the approval of ESOP shall contain the total number of stock options granted, identification of classes of employees entitled to participate in the ESOPs, the appraisal process for determining eligibility of employees, the requirement relating to vesting and the period of vesting as decided by the company, which shall be at least 1 year, maximum period within which options are to be vested, the exercise price or the formula on the basis of which the exercise price shall be arrived at, exercise period and process for exercise by the employees, lock-in period, if any, to which these ESOPs shall be subjected to, maximum number of options to be granted per employee, and conditions under which the options vested in the employee may lapse, for example, in case of termination for misconduct. The statement to the effect that the company shall comply with the accounting standards in relation to the accounting treatment for ESOPs. Certain criteria that have to be additionally dealt with and taken note of before such issue shall be that there shall be the requirement of a separate resolution to be passed by shareholders if the grant of options are to the employees of a subsidiary or holding company, or where the option to the identified employee during a year is equal to or exceeds 1% of the issued capital at the time of grant of the option. This shall require a specific separate resolution to be passed by the shareholders. The company may vary the terms of ESOPs by passing another special resolution, and the full terms of the variation shall be mentioned. Minimum 1 year shall be the time period between the grant and vesting of options. In case of a merger of the company, the period during which options were granted by the merging company shall also be considered for calculating this 1 year time period. The lock-in period, if any, that may be specified by the company. Employees shall not have the right to dividend or vote till the shares are issued on exercise of options. That is, options are not liable for any dividend or voting rights. Amount, if payable by the employees at the time of grant of option, shall be forfeited if the option is not exercised within the exercise period, or refunded if the options are not vested due to non-fulfillment of criteria or conditions. Options granted shall not be transferable, pledged, hypothecated, mortgaged, or any otherwise encumbered.
Just wait 1 minute. Let me clarify that. If the options are not exercised, they get lapsed, they won't be forfeited. There is no question of any forfeiture in case of ESOPs. If I am not wrong, if a particular person is not exercising his options, they get lapsed altogether. Yeah.
Right. So this is referring to the amount that is paid by the company at the time of grant of the option. That would be
Correct.
forfeited.
What is that?
At the grant, if any amount is paid, like if there is a grant.
Normally at the time of grants, no amount is paid. You see,
That's
how
in practice.
the scheme gets operated is that once it is approved by the shareholders authorizes the board or any board committee to implement the scheme. Once the scheme is approved, then that scheme cannot be altered by the board or by the committee, which is not favorable to the shareholders, so to the employees of the company. If any kind of alteration is required to that scheme, while implementing, if there is any hardship is there, they have to go back to the shareholders, number one. Once the scheme, when you are implementing it, you have to identify the people who are all eligible for the ESOPs. Not necessarily if a company is having 1,000 employees, all the 1,000 will get the ESOPs. No, it is not so. It all depends upon who are the people who are important for the company. It is the discretion of the management to identify, a discretion of the board rather, to identify the people who are eligible for the ESOPs. After that, how many ESOPs are to be given depending upon the importance of that person to the company. It also depends upon. Maybe it is about his about his position, grade to which they belongs to, all those things are there. After that, the grants will be given to the employees. Once the grants are given, you will be given X amount of grants. Say, for example, 5,000 shares. Let us take it a ballpark figure. 5,000 shares have been given. After 1 year, the vesting will take place. That vesting is not going to take place for the entire 5,000 shares. Vesting will take place over a period of time again as per the scheme. Normally, it is 4 to 5 years. The vesting may take place at 25% of the grants given to the person will vest in first year, 25% second, third, and fourth year, or maybe 20% in first year and 20% in the remaining 4-5 years. That is how the vesting takes place. As far as the vesting is concerned, it is also subject to several conditions. Say, for example, the first year vesting of 20% takes place doesn't mean 1,000 shares I am getting it automatically. No, it is not so. Vesting will take place again subject to the performance of the company, depending upon what the scheme is telling. Say, for example, in case of RIL, we were having at one point of time, it is the overall performance of the company. 1/3 weightage is given. Another 1/3 weightage is given to the overall performance of the business vertical to which you belongs to. And third 1/3 is to the department, your department's contribution to the overall performance of the company.
So,
So depending upon this weightage, the vesting will take place. Not that 1,000 shares automatically you will get it. No, it is not so.
can I
It
add
is
here just one thing? This is called what Sudhakar is explaining is called a vesting condition. That is, when a company is making the grant, it has to specify that the conditions on which vesting happens. Like this very nice example that he has spoken about in Reliance. In their case, each year the vesting was dependent upon 3 different conditions. The department performance, the vertical performance, and also the overall company performance. Sometimes you can also link to market driven conditions. That is, you can say vesting will happen if the market touches a capitalization of so and so number. So these are all vesting conditions But the key is you can't determine that condition after grant is made. It has to be determined at the time grant is made. Once a grant is made, you cannot change the condition, especially in a manner which is not favorable to the employee. You can change it favorable, but that also you will need employee to agree, because grant actually is a contract. So therefore, you will have to go, even if you are making a favorable change, you will have to go to the employee with an amended grant letter and get the signature of that employee and his consent in that form. Without that, you will not be able to. Therefore, determining the vesting conditions is very, very important at the time of grant. Just one last point on that. It is not necessary that these vesting conditions have to be specified in the ESOP plan. Your ESOP plan doesn't have to include, but your grant letter that you are giving to individual employees will have to state whether for that employee vesting is time-based, like he said, performance-based. Sometimes performance can be linked to the company's performance, or performance in some cases can also be linked to the individual performance. You can say every employee who has a rating of EE will get vesting. So these are conditions you have to specify. I would highly recommend, please include these conditions in the grant letter, and do not specify too many details in the ESOP plan, because if you need to amend anything, you will have to go back to the shareholders, amend through a special resolution, make a filing, and then come back and issue an amended letter. So too much of paperwork. So please specify the vesting conditions as a part of grant letters.
So that means the grant letter when you are
But
issuing to the employee.
only thing, Satya, you have to remember is that if as you rightly said, yes, let the ESOP scheme be as flexible as possible, but it has to give proper authority to the board or board committee
Absolutely.
to decide that
Absolutely.
vesting conditions and all. So that authority should be very clear. And
Absolutely.
based on that authority, as you rightly said, when you are giving that grant letter, that is a contract between the employer and the employee. In
Correct.
that grant letter, as I told earlier also, the clarity to the employee should be there when he will exercise the vested options, and under what conditions the vesting will take place, and on what conditions the vesting gets, and if they are not, options are not exercised, it will be lapsed. So many things are there. These are all to be there comprehensively in the grant letter.
So
Absolutely
that means
with
the
you.
grant letter can be different for the different set of employees.
Absolutely.
Absolutely.
So
But,
that
Absolutely.
but
means
one thing. No, one
But
minute,
don't
Bala.
make it so discretionary
No,
that you get
one minute, Bala. See,
yeah.
as far as the vesting conditions are there, they should be the same to all the employees. Only thing, the number may different. See, you cannot have to some people some vesting conditions and to some people some other vesting conditions. Under one scheme, vesting conditions should be the same. There may be different schemes running parallelly also. ESOP schemes, there are companies which they may come after 2 years for a different class of people. They may come with a different ESOP scheme. They call it as ESOP scheme 1, ESOP scheme 2. And sometimes it may so happen in companies I have seen where 3 ESOP plans are running simultaneously.
No,
It is
no.
possible.
My
I
point is
have
not
a
that, Sudhagar.
I
Sudhagar,
actually slightly disagree with you, Mr. Sudhakar, and agree also. I'll tell you where I agree and where I disagree. Is that even within a single plan, for all the sales team members, you can have a different vesting schedule, and
correct. That's what I was coming to.
for all of your ops people, you can have a vesting schedule. What you should not, what the companies have to be really careful, and for their leadership, they can have a different vesting schedule. What the company have to be really, really careful is that the because you have flexibility, this cannot be subjective and expose company to labor litigations. You need to have objectivity, you need to have a framework by which you are not bringing in subjectivity. So it cannot be that I don't like this guy's face, so I will give this person 8 years vesting schedule, whereas I like this team member, it can be 4. That can never be the case. Whereas you can actually use, because it's an individual contract, you can actually have separate vesting schedules. So long as there is objectivity,
Satya,
it is
one minute,
possible. Yeah, sure. Sure.
let me clarify one thing. When I said that vesting weightage cannot be different to different employees. As I told you that overall performance of the company, overall performance of your department, overall performance of your business vertical, this vesting weightages should not be different, because the moment it is there, it will lead to automatically the disputes among the employees.
Absolutely.
They will say, by how I am different to that person, why my weightage issue is different. As far as the time period is concerned, that is not at all big issue. But only thing, 2-3 things which are very important is, as far as the exercise price is concerned, it is predetermined, so that is not to be changed. Second thing is, according to me, the vesting weightages are not to, it should be the same to everybody. And as far as the lapses are concerned, nobody should have a discretion to consider that lapse. If it is there, it should be uniform. That means all the employees should get the equal benefits. You cannot discriminate among the employees. Otherwise, what will happen is the senior employees will get the cream and only charge reh jayega for the junior employees. That should not be the this thing.
No, my point was, Sudhagar, when you said 1/3 for the vertical performance, 1/3 for the employee performance, within the department, like Satya puts it, the sales department can have a different performance level, quality department will have a different performance level, finance department will have a different performance level.
Correct.
So
Yes.
to that extent, your vesting condition can differ.
Yes. That will be there in your grant letter.
Different
That will be there in
departments.
your grant letter. Yes, no doubt.
That is what I'm coming to.
See, line department and service departments always are different.
Yeah.
Okay, so the line department may get this thing, and okay, that I agree with you. But as far as if you say by okay, line department, as far as the overall performance of the company, they are not concerned with, that should not be there.
No, I'm not coming to that. I'm coming only to this. Yeah.
Anyway, we can say overall it should be fair to the company as well as to the employees. Let us take that thing, the essence of the ESOP scheme. Okay. Yeah. Yes, Jasmine, go ahead.
Yes, Justin, go ahead.
Yes. So we will point that options once granted shall not be transferable, pledged, hypothecated, or mortgaged in any form. No person other than the employee shall be entitled to exercise the option. However, in case of the death of the employee, the option shall vest in the legal heir or nominee of such employee. And in case of permanent incapability, all options on the date of the permanent incapacitation shall vest in the employee itself. In case of resignation or termination of employment, the options shall not that are not vested shall expire, and the employee can exercise options granted which had been vested. Disclosures in the director report. The director.
1 minute. Normally, sometimes the companies put a condition also that even if the options are vested, if a person resigns, before he leaves the company, he has to exercise those options. Otherwise, they will get lapsed. That also the conditions are put by the companies normally.
Right. Disclosures in the director's report for the purpose of ESOPs shall be the options granted, vested, and exercised. The shares arising as a result of exercise of options, the options that have lapsed, exercise price, and variation of terms, if any, that had been made in case of ESOPs. The money realized pursuant to the exercise of options, and the total number of options that are in force as on that date of the director's report. The employee-wise details of the options granted to KMPs, the employees who receives a grant option in any 1 year amounting to 5% or more of the options granted during that year, and the separate disclosure for identified employees who were granted option during any 1 year equal to or exceeding 1% of the total issued capital of the company. Register of ESOPs. The company shall maintain the register of ESOPs in SS6, again maintained at the registered office of the company or any other place decided by the board. And entries shall be authenticated by the CS of the company or any other person authorized in this regard by the board. Implementation of the ESOP scheme can be done through two ways. One is the direct route and the second is the trust route. In case of direct route, the options are granted and held by the company and thereon on the basis of exercise transferred to the employees themselves. But in case of implementation of the trust route, the company grants a loan, creates a separate employee welfare trust and grants a loan for payment or subscription of shares, or directly issues the shares to the employee welfare trust that shall hold the shares till the exercise is done by the employees. Upon the exercise of options by employees, the employee welfare trust will transfer the shares to the employees, and on the basis of money received from the employee pursuant to such exercise, the employee welfare trust will repay the loan that was given by the company. This is the modus operandi for implementation of the trust route. The difference between direct route and trust route, in case of direct route, shares are granted by issuing of fresh equity shares. In case of trust route, the trust is particularly formed for the purpose of ESOP scheme, and the company funds the trust to buy the shares from the secondary market and transfer it to the eligible employees. In case of direct route, employee has the right to apply for the shares once the vesting period is over. In case of trust route, the trust holds the shares on behalf of the employees till the vesting period is over. In case of direct route, there is less liquidity for the company as the shareholder gets an exit only if the company goes in for a public offering. In case of the trust route, employee can get an exit by selling back the shares to the trust. Certain particular compliances mentioned under Rule 16, particularly for the purpose of implementation of ESOPs through the trust route. Any scheme of provision of money for the purchase or for subscription for the shares shall be approved by the shareholders by way of a special resolution. The purchase shall by the trust shall be only through stock exchanges in case of a listed company, and in case of unlisted company, it shall be at the valuation determined by register valuer. The value of shares to be purchased with money provided by the company shall be maximum up to 5% of the paid up share capital and free reserves of the company. The conditions of who can be appointed as a trustee for such a trust is that such a trustee shall not be the director, KMP, or promoter of the company, its holding, subsidiary, or associate, or a relative of such director, KMP, or promoter, and shall not beneficially hold 10% or more of the paid up share capital of the company. This is basically to ensure independence of the trustee. Contents of the explanatory statement to the notice for convening the shareholders meeting for trust route, the class of employees for whose benefit the trust is being formed, particulars of the trustee, particulars of the trust firm, interest of the key managerial personnel, directors or promoters in the scheme or trust, if any, the benefits to the employees from the scheme, and the details about who would exercise voting rights in respect of the shares while the trust hold such shares. Coming to certain case laws related to ESOPs, Biocon Limited versus DCIT, herein the Karnataka High Court allowed ESOP discount to be treated as a deductible business expenditure. In re Segovia, this judgment particularly highlighted that stock option serves as a form of compensation and grants the employee an option to purchase the stock of the company. We had also very recently, that is on 27th March 2024, an ROC Gujarat order in regard the company Crazy Fin Private Limited, wherein the directors and companies were imposed with penalty since they allotted equity shares in excess of the shares approved for allotment under the company's ESOP scheme. And the allotment was done even before the mandatory vesting period of 1 year as per the law. Certain post-allotment compliances, particularly related to dematerialization, referring to Rule 9, 9A and 9B of Companies Prospectus and Allotment of Securities Rule 2014, every public company and private company other than small companies shall issue shares, which include sweat equity as well as employee stock pursuant to ESOPs, only in dematerialized form. And every company making offer for equity shares shall ensure that before making such offer by way of sweat equity or ESOPs, the entire holding of securities of its promoters, directors, and KMPs shall be held only in dematerialized form. I would like to invite one of my colleagues, C.H. Chandan, to highlight the taxation aspects related to ESOPs.
Thanks for giving me the opportunity, Rustin. It was a great meeting. So coming to the ESOP taxation, what we need to understand is on the complete life cycle of an ESOP from the issuance till the process where the shares are ultimately sold by the employees to someone else. They are taxed twice in their life cycle. That is, one during the issuance of ESOP, that is taxed under Section 92 as per TDS sections under the head salary. And we have a second type of taxation, that is for the capital gains, that is when the employees sell their equity shares or the sweat equity shares or ESOPs to the ultimate holder who wants to become a subsequent holder. So these are the two times where the taxation impact will be on the ESOPs. But point to note over here is there are certain exemptions granted by income tax department for this as well. To put it in this way, what happens is, suppose there's a company which is issuing equity shares at a very nominal price compared to the fair market value. It so happens that the vesting period would be 3 years or 2 years. Since they book expense on a yearly basis as per accounting standards, it is also imperative to note that the TDS has to be deducted on those things. So if at all they have to deduct TDS, and this issue of sweat equity shares or ESOPs is considered to be something which is issued in kind, which is not in cash. So basically, TDS is one questionable aspect over here. So income tax has come up with certain guidelines wherein it has relaxed few provisions with respect to ESOPs and has ultimately given an order telling that the TDS liability on an employer to deduct TDS on employee with respect to ESOPs is only during the issuance of shares when he exercises the right. It's not during the vesting period. Until and unless the vesting conditions are satisfied and the employee is ready to exercise this option for ESOP, there is no tax liability arising on both of them. And suppose he is paying tax, of up to whatever might be the tax calculation as per the salary regulations. But later on, when he proceeds to sell those shares, then the tax calculation would be completely based on Section 112. That is for capital gains. It is not as per the salary. So these are the few aspects of taxation that we need to keep in mind when it comes to ESOPs.
Give the example, Chandan. What is the perquisite tax and what is the capital gain tax? Why can't you give an example?
Sure, sir. Sure, sir. Let me take an example. Suppose there is an employee who is being offered an ESOP of 100 ESOPs at a rate of 100 rupees per share, and the fair market value is 1000 rupees per share. Okay. So what happens is the difference between fair market value and difference between the issue price, that would become the perquisite value, that is 900 rupees per share. That 900 rupees per share would be treated as perquisite, and so that calculation would be considered for the taxation purpose as per the heads of salary. This is the actual way how we actually do it. For unlisted companies, the valuation depends on the valuation certificate that they receive on every quarterly basis or every 6 months basis. And when it comes to listed shares, it is obviously the listed share valuation that is already prevailing in the market. This is how we calculate perquisite taxation for the purposes of calculating taxation under the head salary. And when it comes to capital gain, whatever the value that we have computed for the purposes of salary taxation would be our cost of acquisition. And whatever the sale price that we sell it would be a sale value, and the difference between would be considered to be capital gain, and we will be rating it as a long term or short term depending upon the type of security. If it is an unlisted security, then for that security to be considered as a long term holding, it should be at least 2 years. And if it's a listed security, 1 year would suffice, and we will tax accordingly under section 1112A or 1112A.
So that means in the given example of yours, if the 100 rupees is the value of the share and 900 rupees is the perquisite,
Yes.
and that 900 rupees approximately, let us take a ballpark figure of 300 rupees is the taxation. That is
Yes.
a perquisite tax. So the cost to the employee is 100 plus 300, it is 400 rupees.
No.
Am I correct?
No. The cost for the employee is 900 rupees. The cost for the employer is 900 rupees because
If it is, no, if it is given at 1,000 rupees, no, see, ultimately, what is the cost to the employee? The predetermined
employee or
share price,
employer.
1 minute, 1 minute.
Yes.
The predetermined share price is 100 rupees,
Yes.
right? ESOP share price is 100 rupees. So
Yes.
exercise price is 100 rupees, whereas the
Yes.
market value on the date of exercise is 1,000 rupees.
Yes.
So the perquisite is 900 rupees.
Yes, exactly.
Because that is a differential price. So for that perquisite, if that person exercise price 100 rupees, he is paying a perquisite value of 300 rupees. The total cost to the employee is 400 rupees.
You're talking
Yes.
about the cash cost to the
Cash
employee, whereas what
I am
Chandan is speaking.
I am talking about the cost to the employee for the purpose of working the capital gains.
No, then it is
No, no, no.
900. Then it is
Yes.
clearly 900 because the employee has already paid taxes on 900. For calculating capital gain tax purposes, the difference between 900 and whatever is the sale price, that is what will be capital gains taxable. Whereas if
Yes.
you are actually looking at what is the cash, this thing, then that's 100 plus 300, which is 400. But for the cost for capital gain tax purposes, it continues to be 900. And the reason for that is on 900, he has already paid taxes. So he has to pay taxes only on the balance amount.
Okay, got it.
Yeah, you are talking about the cash outflow for the employee, but whereas the valuation is actually taken as on the valuation of the date it is given at 900 rupees. At the valuation side, he will be selling at the time of disposal. The difference between will be worked out for the capital gain. Yeah.
But to add it to one point, it is not 900, it is 1,000 because 100 is already paid as a net cash already.
That
and
is,
the 900
900 plus 100,000. That is
Plus
correct.
100,000 rupees, it is 1,000.
1,000 rupees. That is correct.
And we also need to note certain points which is being decided as per Mumbai bench of courts or other courts. And we also have a ruling given by Income Tax Department that if at all the company which is issuing ESOP is a registered startup, it's a registered startup, then they have certain relaxations as to the declaration of dividend, declaration of TDS. That is, if they can deduct the TDS only and only at the during the time of sale of shares, subsequent sale of shares by the employees, and not only during the issuance of shares
Or
to the
5 years,
or
whichever is
yes, or 5 years, whichever is.
Or at the time of leaving of employment. That is the other whammy that's there. So you know, both are tough ones because, but yeah, another day. But yes, just one thing here. The taxation that we discussed, that it is at exercise and not at grant, is assuming the plan follows the company law rule 12. If you are not following company law rule 12, you know, I know that it is a larger issue. It cannot be ESOPs in the first place, but you know, law will treat them as SARs under company law, and under income tax law, you get taxed on the grant itself. So issuing of anything which is not in compliance law is not at all favorable for neither the employee nor for the company.
Exactly.
Yeah.
So I would hand it over back to Ms. Jasleen to have a conclusion note on this.
Thank you so much, Chandan, for throwing light on the taxation aspects. With this, we come to the end of the presentation related to sweat equity and ESOPs, and the floor is open for the panelists and questions.
Thanks, Jaswin. You're exactly close at 1 o'clock, but open the floor at 1 o'clock now. We have a lot of questions. We'll just have a look at it.
Yeah, I think, you know, I will also say that while, you know, Jaswin was speaking, I was taking a look at some of the questions and responding in the interest of time. But yeah, happy to take the questions.
Yeah, I noticed that you did answer some of the questions in between.
Yeah.
He said, whether vesting resolution required to be passed. Okay. and
at vesting,
noting can be done for exercise option in the next NRC.
Yeah, so technically, if you have set out vesting conditions in the grant letter, at vesting, you don't need any other resolutions. The vesting will happen automatically. Only if an employee chooses to exercise, for the exercise, you need to allot. So therefore, you will need a board resolution only at the allotment. So at the grant of options, you need a board resolution. Only at exercise, again, when you are issuing shares, you will need an allotment. You will need a board resolution. You won't need a resolution in between for vesting.
Whether PAT regulation applicable to
One
employee.
minute, Bala, 1 minute. See, even as far as the board resolution is concerned, also, it is always advisable to authorize somebody to allot the shares, because otherwise the board has to meet virtually every fortnight or every month. In
So
fact,
usually
in
compensation
case of
committee.
RIL, we used to have a monthly allotment. So that's why we have authorized the executives to make the allotment. Allotment can be done by anybody who is authorized by the board.
Absolutely.
Whether PAT regulation applicable to employees trust. If yes, then if the trust is actually transferring 50,000 shares of ton each to the employees, market price is 500 rupees below 10K in 1 quarter, as it mandatory to take disclosure from the trust and intimate to the stock exchange requiring or noting in the next NRC is sufficient.
Can I get the question a little more? Can you just
whether PIT regulation applicable to employee trust? Question number 1. If the
which
answer
regulations?
that is prohibition of insider trading. PIT regulation.
Okay.
Yeah,
Okay.
they are applicable. Insider trading regulations are applicable to ESOP shares also, with some
No, I think
exemptions.
their question was
Then the
when
next,
on exercise, when
then-
trust is giving to employees, do insider trading rules
then
apply?
the next question comes. If yes, then if the trust is transferring 50,000 shares of rupees 10 each to employees, market price is rupees 100, so 10K in 1 quarter, is it mandatory to take disclosure of trust stock exchange required, or noting in the next NRC is sufficient?
I would think that exercise is not a transaction. Exercise, when you're exercising, it is an exercise of ESOP, and it has to be disclosed as exercise of ESOP under the next NRC meeting. There, transfer of shares from trust to employees under the exercise does not necessarily, your insider trading does not apply. But when an employee sells, he has to disclose under insider trading regulations, and he has to do it within the trading window. So he has to go and disclose when he wants to sell, and close the trade within the trading window after that, which is technically 1 day trading window to after you disclose. So you will have to sell. If that sale does not get closed, you again have to disclose next day if you're coming back and doing that. That is what is the insider trading. But Sudhakar, you can feel free to add.
No, it is not so. See, as far as the insider trading regulations are concerned, whenever any employee during 1 quarter, if the trading value exceeds rupees 10 lakhs, they have to inform the company, and the company in turn has to inform the stock exchanges.
Correct.
When we talk about trading, even subscription of the shares also is a part of the trading. When you buy from the market or when you subscribe for the ESOP shares, if the total of that in any quarter, if it exceeds 10 lakh rupees, number one, you have to obligated to inform to the company that you have traded in the value of the shares exceeding 10 lakh rupees, number one. Number two, at the same point of time, whenever you are selling the ESOP shares, at point of time also, again, selling is also a part of trading. When it exceeds rupees 10 lakhs value, you have to intimate to the company. Third question is that whenever you are subscribing the shares, do I need to take a pre-clearance from the compliance officer? Answer is no. When you are buying the shares from the market, yes, you have to take a pre-clearance. As far as the limit is concerned, it is every company has to determine a limit when pre-clearance is gets triggered. That is as far as the company's code of conduct is concerned, beyond which they have to go for pre-clearance. But for exercising the options, no pre-clearance is required as such. But when you are selling the shares,
Yes.
even if those are ESOP shares also, you have to have the
to go and
pre-clearance.
take this up.
Then another thing is that contra trade restrictions. On every designated employee, the contra trade restrictions are there. That means you cannot enter into the opposite transaction for a period of 6 months. But even if for the contra trade restrictions are not applicable to ESOP shares, how they are not applicable, let me explain that. Suppose if I purchase a share yesterday, suppose I sold a share yesterday, I cannot buy anything for next 6 months. However, even if I sold some shares yesterday, still I can opt for my subscribe for my ESOP shares are concerned, I can subscribe it. Today, if I am subscribing my ESOP shares, those ESOP shares tomorrow I can sell it also because the contra trade restrictions are not applicable to ESOP shares. That means if I am subscribing 100 shares today, tomorrow I am selling those 100 shares, then contra trade restrictions are not applicable. But if I am subscribing for 100 shares today and tomorrow I am selling 110 shares, whereas day before yesterday I purchased some shares, that amounts to contra for that extra 10 shares are concerned. So one has to be very careful. Contra trade restrictions are not applicable for ESOP shares, but you have to be very clear about what is my ESOP shares, how I am selling or how I am subscribing and all. You have to be careful about that. These are the compliances as far as BIT regulations are concerned.
How to deal with the unutilized inventory of the option which are not granted within 3 years from the date of the market purchase? What are the options available if a company want to continue with the scheme? Can we create the new employee trust and do secondary transaction for acquire from one trust to another trust? Can we apply to SEBI for extension of the time beyond 3 years?
I would think that you should, assuming that you are looking to continue to use the options for further issuance of ESOPs, you can actually write to SEBI for extension. And that would be the easiest. And generally, I have seen SEBI extends that. They might ask questions, but they usually extend that. Creating a new trust and transferring per se, in my mind, is only optical and not necessarily meets the regulation in spirit. Meeting the regulations in form and spirit both are important. What you're trying to do by transferring is simply trying to meet it in form and not in spirit, and therefore I wouldn't recommend.
Kindly highlight later core difference between the SAR and ESOP considering the offer date and the price lock.
See, SAR or any form of phantom stock, if you take, right, they work almost, the difference is that when you exercise, you won't get a share. In an ESOP, when you exercise, you actually get a share. Whereas in a SAR, you won't get share. You will get the difference in value as on the fair market value less whatever they said is the exercise price at the date the SAR is issued to you. So that is the biggest difference, between SAR and ESOP from an employee perspective. From a company perspective, the biggest difference is in an ESOP, as on the date of grant of ESOPs, whatever is the fair market value, that fair market value is used to create a charge to the P&L. Whereas in SR, every year you have to bring that value up to the current value and create a contingent liability on the balance sheet. That is a big difference on the company side and the employee side. Hope that answers the question.
If the foreign holding company is giving the ESOP to the employees in Indian subsidiary company, is there any RBI compliances? If yes, what is the compliances?
So typically, the answer is yes. Earlier, there was a requirement to submit the plan to RBI. Nowadays, that requirement is not anymore there. But there is an annual return that needs to be filed, and you have to go and disclose the number of options issued of the foreign company to Indian employees, both in terms of numbers and value, in the annual return, which is FLA, to be filed by July 15th. Again, at exercise, there is a separate filing and reporting that is required.
Can we give ESOP to tutors full-time or part-time in an educational technical company?
Yeah, that's a very interesting question. Again, I'll go back to the basics. If those tutors are permanent employees, yes. If those tutors are not permanent employees, no. I know in the market there are fancy concepts of TSOPs, MSOPs, all sorts of SOPs, but the answer is very simple. If it is given to permanent employees, it qualifies as ESOPs. If it is not, if the people to whom it is not given, sorry, to the people to whom it is given are not permanent employees, it it necessarily becomes phantom stock. It cannot be ESOPs under Rule 12.
Can ESOP be issued to the employees of the joint venture company in India or outside India?
If the joint venture company is a subsidiary, the answer is yes. If the joint venture company is not a subsidiary, the answer is no.
If ESOP has been issued.
I know that there is a twist to it. There is a way you can consolidate and show it as subsidiary, even though it is not a subsidiary. Technically, if you have taken that view, then so long as your auditors are okay, I have seen companies have gone ahead and issued ESOPs. But please do remember that that's a tricky situation. But a simple answer is, if it's a subsidiary, the answer is yes. If it's not a subsidiary, it's no.
Bala, one more thing also, that though a company can issue ESOPs to the employees of its subsidiary also, but they should get a separate resolution passed for that. It is, you
Absolutely.
cannot combine both the resolutions. There should be two separate resolutions.
I think that Jaswin has said in the beginning, actually. If you
I
want to
have
do it.
actually one question, and this is something that we have recently heard. Is that resolution to be passed every financial year? Because one thing that we have seen is that if I'm extending the plan now to employ subsidiary employees, at the time I'm extending, I'll get an approval. Is that sufficient? Or every year I'm making grants to the employees of the subsidiary, every year I would need that resolution. What is your
No, no,
opinion on that?
when you are conceiving the employee stock option scheme, in that scheme itself, this should be a part of that scheme, that you are also giving the stock option shares to your subsidiary companies, and shareholders have to separate the issues of the one is for the issue shares to the companies members. This for issue shares to our only company or subsidiary company or that company.
My view is also similar to your view. I have recently heard that every year it needs to be passed. So
No,
I
no,
had
not
a question.
required.
Yeah.
Not required.
Can management terminate the grant of share of the employees who validly received ESOP, but post-vesting employees has resigned?
Now, if the answer is just because they are resigned, you want to lapse, the answer is no, unless the plan states that at resignation employee has to exercise, and if it doesn't exercise, then the options essentially get lapsed. The answer is yes. Because the employee hasn't exercised within the expiry period that Jaswin mentioned earlier, then it is expiry and therefore lapsed. But I wouldn't think that just because an employee has resigned, and not connecting to exercise vesting options can be taken back. There is only one exception to this rule, where an employee has committed a cause and is terminated, employment is terminated for reasons of cause. Company has a right to take back vested options.
That
If
is
we-
flop.
Yeah.
Again, that should be there in the grant letter itself.
Grant letter and in some and usually plan also has a statement that board has the power to do this.
That is primarily, it is called the clawback options.
Yeah, clawback of options.
If ESOP has been issued to the director who holds 10% of the stock of the company, what is the remedy?
Please go and compound.
What is that? What is that, Bala?
If the ESOP has been issued to the director who holds 10% of the stock of the company, violation.
Who is? I couldn't understand the question.
I don't know if it is a compoundable offense. That I have to check in the first place.
No, ESOP is allotted to a director who is holding the stock in excess of 10%. What is the remedy?
So that allotment itself, see, that granting itself is nullified. It is not valid grant. If suppose, if that grant of, see, if the suppose, the grant has given and the vesting has taken place and he has exercised it, this is against the law and the clawback provisions will get triggered. He has to give back the shares to the company.
Okay. Subsidiary
Wrong.
employees, yeah.
That is a wrong allotment. That allotment is not valid.
Now he is asking what is the remedy. When you say that allotment is not valid, when you say it has been issued,
You will have to go to
No.
the ROC and say this is wrong. Please reverse this transaction, sit with the ROC and somehow figure out, because if you have filed a pass 3 everything and your paid up capital is updated, and because pass 3 is an automatic approval, you will have to go and report to ROC and have this transaction reversed.
ROC and ROC has no power to do that.
I don't think that can be done with the ROC. Once it is done with the ROC, there is no reversal.
Yeah. So then you
That
will
is the
have to go
problem.
to the
See, according to me, Bala, it is a wrong allotment. Okay, you have to go to NCLT. That shares are to be
NCLT.
taken back. You go to the NCLT and go for the reduction of share capital.
Subsidiary employees are entitled to ESOP of the parent company.
Yes.
If a company deduct TDS under section 194J, showing them as a professional, so they won't be entitled to ESOP.
Yes, professionals we are assuming are coming up as consultants under 190J. So therefore, no, they are not eligible. There is, however, it is important to mention that, for example, if you see the cases of recent hospitals that have gone listed, where doctors are all consultants, what this one particular company before listing has done is specifically gone to SEBI and said that this is my situation. I want you to allow to grant options to these doctors. They are full-time employees, but they cannot be employees under their, sector specific or whatever their profession is. And I understand that SEBI has permitted in this case, but that is specific approval. But I don't know if you can straight away do that.
But if I'm not wrong, even from the SEBI guidelines also, it is to be only to the employees of the company.
That is correct.
How can from where SEBI got the power to exempt like that?
I understand your question.
SEBI has empowered, SEBI has empowered to give that kind of an exemption. Similarly to the MCA also. So under the Companies Act, if it is something is prohibited, there is nobody else can give that kind of an exemption. If I
I'm
am not
completely
wrong,
with
SEBI
you.
has no power.
I'm completely with you, but what I understand is this has been done on the ground.
I don't think so. Anyway, but okay, we'll leave it.
Do CS and CFO can be on probation, and they need to wait for 6 months to get entitlement? I think this you elaborated actually probation and permanent things. Whether employee contractor be considered here? No, contractor cannot be. That you said actually. Contractual employee or a fixed tenure, that we have talked about it. Consultant also we talked about it. Joining ESOP given to CS and CFO valid as a company employees policy says all employees on probation for 6 months. No, this also you talk, no, whether it is a probation or otherwise and all, he is a permanent employee. The question is only the test of the permanency. Does the startup also get the exemption for the director holding 10% equity?
No, it's only the exemption is available only as a promoter, because promoters are excluded from definition of employee. So for startups, that exemption is available only for promoters, not for directors holding 10%.
Is it safe to say that any employee on the roll will be considered as a permanent employee?
There are roles even for contractual employees. So I don't think just because they are on the roll, they should be on the roles of permanent employee. Then yes, there is a role even for contractual employees. It won't fall into that. There's a role for temporary employees also. So technically role means there is a register, there's a rooster under which all of these people are coming. But if that rooster is for permanent employees, the answer is yes.
No, the question is not the roster. Question is the employment contract. Whether a person is employee or not employee, you will not show as per the attendance register here. You have to go as per the employment contract.
Yeah,
that's right.
And just when there is a just one minute, Bala, just when that about that.
Your voice is breaking, Sudhagar. I don't know. Something wrong. Voice is the problem.
we still can't hear you.
Yeah,
So we cannot hear you.
it's breaking.
See that, is it okay now?
Yeah, it's okay.
Yes.
Just when Shilby Hospital IPO, what Satya is mentioning about SEBI has given an exemption or something like that. Shilby
No, any problem, voice problem. Not able to hear you, Sudhakar.
with this, I will talk to Jaswin later about that.
Okay. Understand
sir.
that understand that company ESOP trust can issue share 10 employees on the exercise on cashless basis. That is trust sell is share and net amount remit to the employee after deducting the exercise price. If such situation, how trust will actually counter income tax issue? Tax will be trust hand or employee's hand since all record in the name of the trust or contract note, etc.
Can you be slower? Sorry, I
Yeah. Understand that a company's ESOP trust can issue share to employee on exercise on cashless basis. That is, trust sell the share and net amount remit to the employees after deducting the exercise price. In such a situation, how the trust will counter the income tax issue? Because tax will be on the trust hand or employee's hand. Since all the records is in the name of the trust, that is contract note, etc.
So in this case, usually what happens is there are two kinds of taxes. There is a tax at exercise and there is a tax at capital gains on sale. But because the exercise and sale is happening at the same time, because the power is given to trust to exercise and sell, what typically trust does is that letter that usually is taken from employee for cashless exercise and sale says that the TDS portion will be deducted from the sale price and will be given to the company to meet the TDS obligations. So trust usually reduces the strike price, also passes on the TDS amount, reduces it and gives it to the company to meet the TDS obligations.
Can a private company issue ESOP to its employees if it has no plan to come out with an IPO?
The answer is yes. If you see a lot of these companies today, right? Zoho, Zerodha, companies that are, completely bootstrapped and much or at a scale of a listed company in terms of their market capitalization, so to speak. They do issue ESOPs. I think what is important is you have to have a mechanism of when employees can exercise and liquidate those stock. So so long as that is determined, there is no issue with there is no requirement to go to an IPO. For example, many of these companies have a program where employees can exercise and transfer the shares to either promoters or have an option to what the market calls buyback. I don't want to use the word buyback. The market calls cash out, where employees surrender the options and get bonus at a book value. So there are different practices in the market on how to liquidate ESOP in such situations, but a simple answer is yes, it can be done. Thank
What
you.
is the main difference between the ESOP and the sweat equity since both have to be for employees?
So technically, if you see sweat equity, right, it's for already work done. So it's a remuneration for something I'm doing because I'm already issuing shares today. Like Sudhakar explained some time back, whereas ESOP says have a vesting period. That is, it vests over a period of time based on conditions that I am. So it's futuristic. So one is for services that I'm going to, or anything that is likely to happen over the next period of time. Sweat is after that know-how has come in, IP has come in, or services have been rendered, I'm actually issuing today. So when there is no vesting, you tend to go towards sweat equity. If there is vesting, you tend towards ESOPs.
Yeah, absolutely. I agree with you because one is actually what you call the job done in the past. That means in the recognition of the value addition which is already has been made. That is what the sweat equity is actually coming in. But when you talk about the ESOP, it is actually, as you rightly say, it is futurity subject to what is that grant letter. Can excise price be the face value?
Additionally, the definition and ambit of employees under both these sweat equity and ESOPs is quite different.
Yeah. Can the exercise price be the face value?
Yes, absolutely. There is no, there is no restriction that it cannot be face value. But please do remember, it cannot be lower than face value. It has to be a minimum of face value.
Okay. I think some of the questions you already answered that I'm not taking it here. If ESOP appreciation right need to be exercised when offered or later.
I'm assuming they're talking about phantom stocks in ESOP stock appreciation rights. What is the question?
Is ESOP appreciation right need to be exercised when offered or later?
No. What exercise means is you're getting cash, so it's at a later stage. But do remember that because SARs are technically not under your Rule 12, you can actually say that SARs vest and you can exercise immediately also.
Nowadays, so many startup unlisted issues ESOP to its employees and is getting accumulated. Neither the shares of the company are listed, nor the company is giving any buyback option. Is it worth to exercise this option?
Can you please repeat? Sorry, I missed.
Nowadays, so many startup unlisted, they issue ESOP to its employees and it is getting accumulated. Neither the shares of the company are listed, nor the company is giving any buyback option. Is it worth to exercise the ESOP option?
See, it again depends, right? And we need to understand, like I first said, you have to look at ESOPs as an investment, right? And if you think that there is no liquidity, would you want to exercise options? That depends on whether you believe in the future of the company. This company will go towards an IPO, if not today, in next 4 years, or there is an opportunity that someone will come and acquire this company. So therefore, I see value in this investment and therefore that exercise. So which is the reason, if you see, most people exercise only when there is a liquidity option. They don't exercise unless liquidity is in sight. And sight means, I know that in listed companies, it can be, a 6 months to 2 years, or you're very early on where the taxes, you're exercising it in the first year itself, where the taxes is not a huge burden on your pocket. So you're taking the risk with that investment and exercising very early. I think those are the two reasons I would think that people have to exercise. But remember that ESOPs, just like your unlisted stock, are risky, and you really have to evaluate their potential and the risk involved and exercise at the right time.
What is the exit option for the unlisted company?
Many, right? Many. Look at look at the poster boy of India in unlisted space, Flipkart, right? It issued ESOPs. People didn't know what to do. 11 years on, Walmart has come and acquired them and cashed out ESOPs. Is there a value even if company is not looking to go for IPO? Yes, there can be an M&A. Look at Zerodha and Zoho. Both are not going towards listing, and I don't think they are anywhere closer to being acquired also from that perspective. But both those companies have very lucrative options, and employees do get liquidity from their ESOPs. So there are multiple ways today ESOP liquidity can be given, and that's where we also come from. If you see, we said we bring liquidity to illiquid assets. So there are multiple ways liquidity can come through, and therefore ESOPs are still valuable.
I think it is already 1:30. I think we may have to stop. I think so.
Absolutely.
Although there are some more questions are there. I think probably just in this question can be answered individually later.
Yeah, we
Certainly, sir.
can.
Yeah.
Yeah, we can.
Yeah,
Because
it's already
even I was.
1:30. Yeah.
How many questions are to be answered yet?
I think more than 25.
Oh my goodness.
Yeah.
Oh,
That is why I said the time is up
wait.
actually.
No,
Yeah.
no, we cannot.
We can ask them to email it to us, and we'll definitely get
Yeah,
back to them.
yeah. We will get back to them.
Yeah.
Yeah, thanks, Jaswin, for your good presentation. Thank you, Ms. Satya, for all your practical tips and at the last mentioning how the ESOP can be a liquid option, even though it is illiquid. That was a wonderful presentation. Thanks for all inputs. Thanks for your time and such a You were so engrossed on the topic, it can be visible. Thanks a lot for your time. Thanks, Sudhakar. Thanks.
Thanks,
Thanks,
everybody.
Satya. Thanks, Satya, very much, because I really enjoyed your session. Your practical insight is very
Here
great,
we end the
actually.
session. Please.
It is a very nice learning. And Justin, you have done an excellent job. Let me tell you, you have done a thorough homework. You have done an excellent job. You have put everything in the encapsulated form. And not only that, your flow was so good. So nice. My appreciation to you.
Thank you so much, sir. Thank you so much. Means a lot.
Thanks a lot. We close the session with this. We yet meet in the next week with some other topic. Thank you.
Thank you. Thanks all. Thanks for the opportunity.
Thank you. Good day.